Hello and welcome to your online economics class. This is the first video in the series of videos on financing and investment. First, let's go through some basics. Let's have a look at finance and money. Study of finance looks at how households or people and firms obtain and use financial resources and how they deal with the risks that arise in this activity of using these financial resources. The study of money looks at how households and firms use money, how much of it they hold, and how banks create and manage money, and also how the quantity of money influences the economy. So as you see, the study of finance is a little bit different from the study of money. The next basic thing is the difference between physical and financial capital. The physical capital are all the tools, instruments, machines, buildings, factories that the firms use in order to produce goods and services. Financial capital is all the funds that the firms use to buy or build that physical capital. And the third basic thing that we want to mention is that net investment is equal to the difference between gross investment and depreciation. For example, let's say at the beginning of the year, in January, your company starts with, say, 7 trucks. Let's say during the year, 2 of those trucks are completely destroyed because of the wear and tear, and they are written off. However, in December, by the end of the year, your company finishes with 11 trucks. Starting with 7 in January and finishing at 11 in December means that we had to buy 4 trucks plus 2 to cover the depreciation of the 2 written off trucks. That's a total of 6 trucks, which is our gross investment. However, subtracting depreciation from that gross investment, 6 minus 2 will give us a net investment of 4 trucks, which is simply the difference between the beginning amount of physical capital and the ending amount of physical capital. And the last simple thing we want to mention is the difference between wealth and savings. Wealth is the value of everything that people own, everything that people have, while savings is what is left from income after consumption and taxes. Clearly, savings increases wealth. Savings is the flow into the total stock of wealth that people have. Besides savings, capital gains and capital losses can also change wealth. Next, let's talk a little bit about financial markets and financial institutions. Savings is the source of funds for financial investments. These funds are supplied and demanded in 3 types of financial markets: loan markets, bond markets, and stock markets. Talking about financial institutions is a firm that basically works on both sides of those financial markets, or the markets for capital. Financial institutions would include commercial banks, pension funds, insurance companies, and others. Working on both sides means that financial institutions act as part of the demand for funds when they are dealing with savers, and they act as part of the supply of funds when they are dealing with borrowers who want to obtain funds from those financial institutions. Net worth or capital, these two are 2 names of the same thing, is the difference between assets and liabilities of a firm or an individual. If capital is above 0, that means the firm is solvent. If capital is below 0, if liabilities are greater than assets, then the firm is insolvent and is likely to go out of business. interest rate on a financial asset is the interest received as a percentage of the price of that asset. For example, if there is a bond with a face value of $1,000, meaning that if you hold this bond until it expires, until maturity, you will receive that $1,000, but you originally buy that bond for, let's say, $900, then the interest rate is 11%. The $100 that you receive in interest is 11% of the initial price of the asset, which was $900. In another example, if you lend $2,000 and after 1 year receive $2,100, in this case the interest rate is 5%. The interest received, $100, as a percentage of the original price or the original cash outflow, which was $2,000 in this example.